Uh, Hello and welcome to the BISP Solutions. And today we are going to talk about different logics and how it works and what are the different things. Right. So, welcome back to the channel. If you are new here, my name is Prakash Singh, and this channel is all about making the finance and Oracle TRCS concept simple and easy to understand. Today, we are going to talk about something that often confuses TRCS beginners, the key logics in the tax reporting cloud service that are annualize, de-annualize, pull, movement, and squeeze. Now these might sound technical, but don't worry, I'll explain you that how it actually works. So before we work into any automation itself, that how we actually get the value. Before getting that, let's understand how it actually works, how we actually pull the values from what logics, right? So I'll explain each one step by step in means with the real life examples. By the end of the video, you'll not only know what this logic means, but also how they are used in the tax reporting and the automation. So let's get started with it. Okay. Before diving deep, let's see that how these automation actually works. So under configurations in our application, we will go there. Under this, you can go under the tax automations. Might take some time to load. Okay. So here you can see that there are different logics. We have put pull logics, we have here squeeze, we have movement, and many more if we actually drill it down. It's not loading due to some reason. Okay. Oh, here we got it. We have a pull, movement, squeeze, annualize, and de-annualize. These are the five main logics what we are going to work on. Right. So, first, before actually going in depth with the application itself on Excel, let's start at how actually it works. So we will first start with our annualize, right? So here, what we mean is here the annualize refers to converting a partial year data into full year equivalent, right? So let's take here annualize, right? So we are going to take an example that, for example, we have different months. Let's go Jan, Feb, March, April. We have May. So like this, if we can. Okay, it's actually letting me. Let's take June, July. So here we have our 12 months, right? So, for example, we only have the value for 1 month itself, right? Here, the 1 month can we can take either it can be that April for here we can take means the value can be from April or May that we can say, or we can take Jan to Feb, or we can even take it's on you that how much actually you want to take the value take. Uh, So under this, we are going to take from I think April to June. That is a 3 month, right? So I'm just going to use the color to make it means let you understand it. We will put a green color on it so that you can understand that what I'm talking about, right? So from April to June, that is a 3 month, we have our value that is 9 lakhs, right? We're going to merge this and we will put, we have our 9 lakh right here. But we have to actually apply that for the whole year, that is on whereas 12 months, what is the total value for it, right? So it's a simple mathematics that you can do. Either if you can do it either way that there are 4 quarters and each quarter have 4 months, right? So if you have for three actually months, that means you have for even 1 quarter. That can be 9 lakh into 4 either. That will give us 36 lakhs, right? Or with a formulation, easy formulation, means here you have to calculate for the rest of means for all the 12 months. If I can get a shape, yeah, we need it from here to here, right? This is we actually need the value from January to December, the total value from which we can actually use a de-annualize method to actually know the per month value, right? So we are going to put the formulation. For example, these are 3 months that we are taking. So one is the way that we can take that monthly one. That if it is a monthly, it is 10,000. For example, if we have this value again, or we have this copy and paste. For example, if we have, let's take a further more forward. Okay, here of Jan we have 10,000. Right. We need it for all the 12 months. So that means for 1 month, if it's 10,000, then we can do it as 10,000 into 12. That will give us the total. That is our 12,000. Right. And there are different actually techniques for it. One is under the 9 lakh ones. If there are 3 months I have taken in the 9 lakh ones, we can even calculate it for uh, actually just let's put in for 2 months, 3 months, or even 4 months. Under the application you can have that you just have to feed the data to the application that for which month you have the data itself. Like for example, I have taken here January, right? So each in January we will have 10,000 for all the ones. That will make us 12,000. Now if we want to know that what is for the each month or what is for the 12 months, then here just for 3 months, that means 1 quarter, right? So here we can do is 9 lakh equals into 4, right? There are 4 quarters in a year. That will give us 36 lakhs. Or either we can use another formulation which will actually help us to find the value itself. That is, let's take the 9 lakh, that will be, we will multiply it by 12 by 3, right? 12 by 3 because we are actually taking 12 by 3. Okay, here we have 12 by 3. Right. So that means that here the 12 we are denoting is the months that we have the 3 months and we need the 12-month basis. So here when we will apply the whole formula, we push enter. Okay, it's not actually going out of the, so we can say that this will be 4 and if we into from 9 lakh it will give us 36 lakhs itself. So if we have here, we will just put the value, right? We will choose that we need it to be annualized right here. We will just put the formula. Let me tell you that from where we can get it, duplicate it and duplicate it. This is the actually middle part between the two forms. One form is what from the base level it's taking the valuation, and another will be where it is putting the putting the value itself after changing it. And the configuration logics come in between of both of them. So here we'll go to a source that is under library. Under library we can go to, it's not loading. Okay, here we will go to tax provisional national. Here we will go to a library. Let's wait a little bit as it takes time, right? Under the book data, we are going to search for balance sheet by source. Here we will go search for bad debts. We can't find bad debt over here. It's not a big problem as we are not doing means currently going with it. So from here, the valuations of different accounts are actually taken from this point, and through configurations and different logic, we are putting it here in current provision. Also, in this procedure, after we take the balance from here through the configurations and the full movement, we save it right from here. Then in action, no, from current provision action, after whatever you have changed from the configuration, after refreshing it here, you have to run different the rule so that it can be implemented to the specific period that you have actually made change to from here, right? Here you can change the period itself, that is the P12, or the year, that is FY22, the scenario, or even the account itself, that from what target account you are actually making it for. Here you can see under the revenue recognition, it is from national and regional pre-tax, right? From under which thing it is actually, you can say, for example, here we will take that we have balance sheet. So under balance sheet, here it will put it like a star and it will say bad debts. So as this it shows that from where it is going and where it is being put it down. So here we have 9 lakhs, right? Under the example from right here. So this helps compare the 3 month data with the full year period. So now we have actually that we have our whole year, that is 36 lakhs for all the year, that is for 12 months. Now we can actually get per month if we need to be analyzed. So under the per month, you go here equal to this, then divided by 12. So that means you have per month 3 lakhs. Any valuation that you have calculated, this is the logic of annualize. Now, if you talk about the de-annualized one, we will take the same example. Under this, we're going to go for de-annualize. So, let's first talk that what the de-annualized refers to, or annual, and how it differs from the annualized one, right? So here you can say that it breaks annual value into months and quarter figures, right? Here we are talking about that we get the annual value 36 lakhs. Then here we break it into that 3 lakhs each month, right? This is what the de-annualized concept is. We can take another example apart from this. For example, if we come here and we get a shape, this is the one, this thing, right, is have the total valuation of what we can say is 12 lakh. Right. So we need to actually find that what this is actually we can say the rent expense. Rent expense. It's the rent expense. So we have to actually calculate what will be the per month rent itself, right? So how we are going to calculate it? So here it is that 1 by 12. So here it will be 12 lakhs divided by 12 will equal to C, 1 lakh each, right? For quarters, it will be 1 lakh into 3. If we actually need for the quarter itself, if we need for quarters, that is this much. Here we are gonna go into 3 lakhs into 3. That will bring us to 3 lakhs. That will make it 3 lakhs. So under de-annualize one, we can take monthly itself. Actually, you can say that we have it for whole year. We have value for whole year, right? That was our 12 lakh. Then we have to take out value that is for monthly or quarterly, right? So here for monthly, we put the formula that was 12 lakhs divided by 12. That gave us 1 lakh. And for quarterly, this is the actually calculation behind these logics, right? So actually, I'm telling you what is the calculation, how it pulls the values from one point and how much pulls the value. So if we may actually want to have the de-annualized value, so this is how we get it, right? So now we have 1 lakh here. So under quarterly, we are going to put 1 lakh then into 3, right? That will give us 3 lakhs. So this is how de-annualized works, right? This is the same vice versa from annualized. Both are workings are same, but in annualized one, we are actually given for a specific month the data for a specific month, and we have to then take out for all the months altogether that what will be the total for all 12 months, right? And from that we can then go for per month, quarterly, or half year itself. But in de-annualize, we get it for all the years, that is our 12 months. Then from there, we have to find it for a specific month, or we have to find it for quarterly or half yearly from that point. Right? We can go here for half yearly also. So half yearly will be here. 6, we can just do 1 lakh into 6, right? That will give us 6 lakhs. This is how it works. This was the working of our annualized and de-annualized logics. Now we are going to go on our next and important logic throughout, which we actually use it mostly. That is the full logic. Full logic. So here we are going to work with the full logic. So full logic doesn't have actually months or according to, it's not like annualized or de-annualized, right? It just means that carrying forward the balance from one period to another. Okay, so let's take example right here. We have a 2024, then we have a 2025, then we have a 2026, 2027. So there are different actually periods that we're gonna take it from. Now under this, uh, here we have the value 20 lakhs, right? Then we can this will also have the 20 lakhs because we are putting it from one period to another, right? And for example, now in 2025, we have the closing balance in one of the accounts. We can take again the rent expense, that is a 15 lakh. Then this will be pulled from 2025 to 2026. Then again, we have here a rent expense of 10 lakhs. Then we are going to take this amount from here and we are going to put it under here. So this is how from each year, from each previous year, Pull Logic pulls that amount and put it in the next year. Right. It is especially useful for tax losses and credit deferred tax. Right. Many companies can make a loss of actually, for example, we have taken 20 lakhs itself. That was for 2024. Now, so tax rule allows carry forward for 8 years. Right. So, for example, instead of taking it once, we can actually take it for all the years till here and here, till it expires. What we can say. Now, for example, 2024, it happened, the loss, we have deducted nothing. In 2025, we deducted 1 lakh. So the new amount here will be 19 lakhs. Then we are going to take, there was actually nothing deducted, or we can say that again 1 lakh deducted. So it will go to 18 lakhs. So we are taking the amount that is actually remaining right here. So here we would have the amount that is a 19 lakhs, right? Here we will have the amount 18 lakhs. I'm gonna put both of them in bold so that you can understand it that these were the total amount after deduction, right? So this is how it works actually. Now under this, if we go to our actually system under which application under which we have our configurations, here you can see there are percentages also, right? So it is actually a good time to actually discuss the percentage also. So for example, if according to the tax authorities, it is only allowed that you can pull the 50% out of the whole 100%. For example, here we have 1 lakh. Now, only 50% is allowed. Out of this, only 50% is allowed to take to your final account or final report, you can say. Right. So, what will be the value here? So here the valuation will be that will be half the value. That means 50,000. We can apply it from right here. You can just apply that how much percentage you want, and it will automatically change here. But you have to actually to see the change, you have to run the rule itself. Here the rule is that are how we consolidate it, right? Now, if we can take another one if you need. That is, for example, uh, we instead of this we can take that here we need 30% rather than 50. And here the valuation we can take 50,000. Then what we will get here, we will just put the formulations, 15,000. So this is the hard works that we do manually on the Excel sheet. But rather than doing this manually on a sheet with formulas and different actually sums or actually auto sums, we can just do it here from the automation itself. We just have to actually put that what logic we want to follow. For example, we will go here. We can just choose whatever logic we like, right? We are going to select it. Under the percentage, we are going to select that for what percent we need. Then we have to actually go that here we have it for the meals, right? For tax and national and regional, it is under the pre-tax. So from where it is coming? So we will just choose the source from here. Here we will enlarge it. See, here we get. You can even search it. Like if I go for bad debts, here you can see I have bad debts here, or under target. No, it's automated. Now here is the source movement, that from where it is actually moving. That is our balance sheet by source. Here you can see that there are different types. We basically work on trial balance closed. We have our depreciation, we have our deferred tax, right? Closing books and different things, right? So now we are going to go on our other logic. That was our movement logic, I think so. Oh no, squeeze logic. My bad. Squeeze logic. Right. Let's make it bold. All right. So TRCS logic here is to force the balance to match the closing total. Right. It is used when rounding or mismatch occurs. So basically, how it actually works is like, let's take an example that here we have opening of 1 lakh. Then we have a movement of what, 40,000, that we can say in addition, right? Then we needed that the expected closing will be what? So let's move it. Yeah, okay. On this capacity. So the expected closing was on what? 1,40,000 according to this after addition. But the actual reporting was what? Let's take actual reporting at 1,30,000 or 38,000 or 35,000. Any one of the figure can work. Let's take a smaller amount, means around the expected closing itself. So we can go with 1,38,000, right? So here you can see that the opening balance was 1 lakh, right? The movement ended was by total 40,000. So according to it, we need the expected closing was 1,40,000, right? So here now, but when the actual closing happens, the closing balance was 1,38,000. Now here the squeeze logic works, right? So if the actual reporting closing was 1,38,000, difference was 2,000, right? Difference was 2,000. That was minus 2,000. Minus 2,000, right? Now, the TRCS will apply the squeeze, right? For it, now we have our differences right here, that the expected closing was 1,40,000, but the actual closing is 1,38,000. So here we can get the difference, that is at 2,000, right? So without squeeze, report won't tire. Right. It is basically used in the currency conversion, surrounding issues, or the manual adjustment, you can say. So it actually, you can say that the uh, squeeze is the adjustment that are made to make the numbers tie. That means if we have 1 lakh, we have to make 1 lakh right here. If we aren't getting 1 lakh, we have 1 lakh, but we are getting 90,000 right here. The squeeze method will help us to get that 10,000, right? So what it actually will give us after adding it, 1 lakh itself. This is what squeeze logic helps us with, right? So these are logics that I am actually telling you can be actually carried out all in the different reports here. As you can see, here we have the current provision. We even can apply it on the TAR. Okay, here we have the TAR, even on the RTA, ETR, and NOL also. Wait a minute. Let me get that. So it can be applied in all of these forms from configuration itself, right? Now let's come to our the last logic, that is our movement logic. In the upcoming session, we will actually study that how these logic actually help us, or we can say that how this logic actually work, the working of these logic, right? So here is our now movement logic. So movement logic here refers to that it calculates what is changed in the balance during a period, right? So here you can actually say that there is a formula for it. So we can say that formula on which it works is the closing minus the opening, right? From which it actually enables us to, means it actually helps us in knowing what portion is new or used, right? For example, if you have 1000 on opening and you have 2000, or you can say instead of 2000 you have 3000 in closing, open and close, then that means here the movement logic will give 2000 difference. That means this 2000 is actually new. There is some addition, right? And in terms of used, we can just take the same example. We will just change the valuation here. Instead of 1000, we will take here 3000. Instead of 3000, we will take 1000. That means here the movement will be negative. That means here the actually here the portion was used instead of means additional portion introduction. It was actually used, right? So we can just take an example under it. For example, if we have a DTL, that is a deferred tax liability that we have actually studied in our last session. If we go to the DTL, here under this we have our opening, which will be 5 lakhs, right? And we have a closing under this, that is our 8 lakhs. So what will be the difference will be here. This will be, so we have 3 lakhs difference, right? So this 3 lakhs goes into the current period tax expense, according to if we are actually making it for DTL, right? We can take another case of closing and opening balance. Let's take the tax loss opening balance. We have a tax loss. Under this, we can take the opening. Okay, we have our opening here. We can take, let's say we have taken 5. Let's say that we can take 10 lakhs right here. And closing can be a 7 lakhs. So what the movement is of? It's of 3 lakhs, right? So that means the total tax loss was at 10 lakhs, right? And closing was 7 lakhs. Here that means that we have actually deducted or the utilized the tax loss during that specific year, right? Because instead of growing, it actually it's reduced by 3 lakhs on the closing balance. So here the movement is shown in TRCS report like deferred tax rolled forward. So it can actually help us in identifying whether the balance increased due to the new temporary differences or decreased because of the utilization. Right. So the movement explains how we can say that the movement refers or explains that how a balance changed, not just the final balance. Right. So let's see some of the few points under this. We have, let's go here under, we have our meals here, all right. Under the permanent differences, we have our meals right here. That is 1,06,000, and this is for P12, right? Here is a meal that is 50%. Let's change it to 70%, or let's change it to 75%. We will save it. Right, okay, we have saved it. So here it was 1,06,000. So now let's refresh it. Force consolidation. Or here, yes. And we will launch it. Okay, so there is some error. Think let's see that what error we are facing right now. Post consolidation. A method called where the script failed on my unit with error. Ownership data. Okay, so due to the actually we have just opened under the configurations from enable features the ownership data. So we haven't actually filled up all the data. So because of these, we have created dirty cells which are yet to be filled. So because of this, we can't actually run a consolidation, which is creating our error. That is that it is actually here you can see that for P12, dirty ownership data present for P12 period 12. That is it. So it's not a problem. But when you actually apply that all the logic from here, and when you actually uh, yeah, let me actually navigate to that page itself. Here we can see that valuations, different valuations. Was it on the current function? Oh, what is this? Here we can see we have a meals. Let's search once that if we can get a meals right here. Okay. I think PNL income statement by source. This is the one I mean. We will go for. Okay, we do have the valuation here. You can see we have 2,12,594, right? So we are just gonna put that we have. Let's just take a new sheet. We have our meals, and we have what was the value? It was 2,12,594. 2,12,294, right? Or 594. This was the value under meals, right? From so this was a source under the configuration. What we put is our pull data. That means pulling it from one place to another, right? So here we have taken 50% before actually changing it. So in the box, we will just put 50%, right? Here we will see that we have just changed it to 75, but before it was 50%, right? Now, under this, if we come at 50%, so the what will be the valuation to a target? So here a source was the income sheet, and here the target is to current provision, right? So now let's put the formula that will be this. We will multiply it by 50%. It was 1,06,297. If you go right here, you can see here we have the amount 1,06,297 right here. Right. Same is for the actually entertainment. Then we have here squeezed. This will actually take time and I have to configure the error itself. So we will actually look it up with while we are working on a different automation. So we will discuss it then. So apart from it, if you have any doubts, you can comment in the comment section, and I will reply to you on the next session itself. That will be on our RTA, that is our tax account, that is our adjustment in the P13. That is done for that when after the you have closed your books. That can be on March or December according to your closing time. After that, if there arises any adjustment, where all those adjustments go to, right? So we are going to study about that. So thank you for connecting with me on this session.